this chapter, we're going to be talking about the rest of the assets. So these are our non-current assets: plants, property, equipment, things of that nature. You'll be exposed to in the text and through the lecture. Looking at how the cost of land, buildings, and equipment is reported on the balance sheet should be a refresher. How the words capitalize and expense are used in respect to property, plants, and equipment. Some of the methods of depreciation for financial accounting purposes, and compare the relative effects of those on the income statement and the balance sheet. We'll talk about the treatment of maintenance and repair expenditures. We'll explain why depreciation for income tax purposes is actually really important and how it differs from our financial accounting depreciation. We'll describe the effect on the financial statements of the disposition of our non-current assets, either by sale or abandonment. We'll look at what the difference is between operating leases and capital leases. We'll explain similarities in the financial statement effects of buying an asset compared to using a capital lease to acquire the rights to an asset. We'll talk about the meaning of various intangible assets, how their values are measured, how their costs are reflected in the income statement, and explain the role of time value of money concepts in financial reporting and the usefulness in decision making. Actually have a time value of money lecture video that is independent of these. What are non-current assets? Non-current assets are assets that have the ability to generate revenue beyond 1 year. So they go outside that 1 year, that operating cycle threshold. They're assets because they are owned by the organization. But as you notice here with the word intangible, does not mean they have to have physical substance themselves. They include land, buildings, equipment, a variety of intangible assets, natural resources. We'll look a little bit at some of these as we move forward. So the primary issues that revolve around non-current assets are: we need to account for them at the point of acquisition. We need to account for what we call the depreciation or the cost allocation of the asset over its useful life. That represents decline in an asset's useful life. While we have it and we're using it, though, there are going to be some things that have to happen most often. And that's going to be maintenance, basic repairs, and what do we do with those costs? And then eventually, because assets generally are going to have some limited lifespan, what do we do at the end? How do we get rid of it? How do we account for it when we get rid of it? And what is the effects of that on the financial statements? We're going to start with the easiest asset, and that's actually land. Land itself is not deemed as being ever used up or having necessarily a limited life. Because of that, land is a non-depreciable asset. The acquisition cost of land includes all of the costs that are incurred and experienced to get the land ready for use. This includes the costs of the actual purchase price, any real estate commissions, titles and legal fees, costs of raising a building that already exists on the land, any delinquent taxes that may need to be satisfied, insurance premiums. It's to get the land ready to be used. Next, we're going to look at the acquisition of land. So let's assume a company pays $250,000 to purchase land and get ready for its use on January 1st. The entry that we would use to capitalize the $250,000 purchase is we would increase the asset land through a debit, and then we would credit or decrease cash for what was paid. Now, if 5 years later, on January 1st, that same piece of land is then sold for $300,000, the entry to record the sale would be an increase in cash of $300,000. So we would debit cash $300,000. Now we only have $250,000 on the books for this piece of land. So we reduce land to zero through its book value of $250,000 as a credit. And then the additional $50,000 that we received would be a credit to the gain on sale of land. We made $50,000 just by selling this piece of land. Now, many times when you purchase real estate, it comes with a combination of a land and a building. For accounting purposes, we have to actually separate that combined price. The total cost of the basket purchase is a combined purchase of both the land and the building and whatever else may be on that land. What we do is we allocate to each asset the appropriate percentage on the basis of the relative market values, and each asset is then recorded separately. So to illustrate this, we're going to use UPCO. And on January 1st, they purchased a parcel that had a land and a building for $200,000 cash. The appraised values, so the value that is appraised just for the building, sans land, is $162,500. And then the land itself, without the building or anything else, has a value of $87,500. These are their relative market values. So the question is, how much of the $200,000 purchase price will be charged to the building and then to the land accounts? Because those are treated differently. They are separate assets, and we need to record them separately. We start with the appraised value. We list the land and the building and each of their appraised values as a total $250,000 appraised value. We're going to take the cost, or what we actually paid for it, and apportion it to the land and the building based on the percentage of each of the assets appraised value to their total appraised value. So $87,500 is 35% of the $250,000. So the land, we will then allocate 35% of the $200,000 to it. We do the same thing with the building, and we now have a portion cost of $70,000 to land and $130,000 to the building. When we purchase a piece of equipment, whether it's buildings or equipment, there's a variety of costs that go into getting an asset ready for use. It's not just how much we paid for it. It's not just the purchase price. We capitalize all costs for buildings and equipments that are necessary to get that asset ready for use. This can include the actual purchase price, of course, any additional architectural fees, costs of permits, installation costs, transportation costs, excavation and construction costs. This can go on and on. But basically, whatever must be incurred in order to get that asset ready to be used in operations are capitalized or added to the cost of the assets. Once we've collected all these costs to getting an asset ready for use, and we have them on our balance sheet, that asset is going to be used in operations over many periods of time, not just 1 year. We have to take those costs and, as closely as possible, approximate to the matching concept, allocate them to those periods in which they're beneficial to us. So to do that, because the outlay is all on the front side, so that's why we capitalize it. We recognize it as an asset useful for multiple periods. We engage in what's called depreciation. Depreciation is the allocation of the cost of the asset to the years in which the benefits of the asset are expected to be received. It is an application of the matching concept. The original cost of the non-current asset represents the prepaid cost of economic benefits to be received in the future. Those acquisition costs of the assets are presented on the balance sheet. Over time, we allocate this cost in pieces to the income statement. The amount that goes to the income statement as an expense cost is the amount that is deemed as used, and the amount that remains on the balance sheet shows the unused portion of the prepaid economic asset. In no way is depreciation an attempt to recognize a loss in market value or any difference between the original cost or the replacement cost of the asset. In most cases, the market value of the non-current asset can actually increase as they're used. But what is called appreciation, an increase in market value, is not presently recorded. So just as a reminder, all depreciation is the cost allocation, is it's showing that these upfront costs, these prepaid expenses are being used, are being allocated over to the periods in which they're beneficial, the periods in which they help us to generate revenue in adherence with the matching concept. The depreciation expense is recorded in each fiscal period. This can be done on a monthly basis, a quarterly basis, or an annual basis, depending upon the size of the organization. Depreciation, the amount that is calculated for the depreciation for that period, is debited to the depreciation expense. This shows up on the income statement. We then post to a contra asset account accumulated depreciation, the same amount, to show that much of the original cost of the asset has been apportioned to the income statements. Contra asset accounts are used to segregate total depreciation that has been recorded from the original cost of the asset and allows us to keep things very transparent. So let's look at what depreciation looks like on a balance sheet. Accumulated depreciation would appear on the balance sheet as follows. An asset is reported at cost, and that is all the costs incurred to bring it to use. And then the accumulated depreciation is reported as a deduction in the cost to arrive at what is called the net book value of the asset. So this is the amount of remaining value that the asset has for the organization. So for example, the asset building is reported at $100,000, less accumulated depreciation of $15,000. This yields a net book value of $85,000 for the building. The asset truck is reported at $25,000 original cost, less accumulated depreciation of $10,000, which yields a net book value of $15,000. When looking at a balance sheet and you look at accumulated depreciation, you can recognize the amount of cost allocation that has occurred attached to an asset over its useful life to date. This has no direct tie to the current income statement. So while accumulated depreciation on December 31st might be $15,000, the depreciation expense may only be $2,000. The accumulated depreciation account functions much like a piggy bank in that we just continue to add to that actual account the amount of depreciation we are experiencing. The amounts that show on each income statement will differ from the amount of accumulated depreciation on the balance sheet. Remember, we close out that income statement every year. So those amounts then zero out. The amount does not zero out off the balance sheet. Your depreciation expense is the calculated amount of depreciation for the current accounting period that is reported on the income statement. Whereas accumulated depreciation, a contra asset account, includes the total of depreciation that has been recorded for an asset as of the balance sheet date for its life with the company. Next, we're going to talk about some depreciation methods. There are a few of them that you have already been exposed to. So cost allocation can be done in a number of ways. Management may decide to use what's called an accelerated depreciation method rather than the straight line method for financial accounting records. In the early years of an asset's life, accelerated depreciation methods result in a greater depreciation expense and a lower net income than straight line depreciation. Let's look at those a little more closely. So with a straight line method, things such as straight line or units of production, you're going to find that the depreciation expense will remain basically the same. Whereas using one of the accelerated methods, such as sum of the year's digits or declining balance, we have a much higher rate of depreciation early, and then as time goes on, it drops down to nearly nothing. Starting with the straight line method, which is the most simple, the basic formula is annual depreciation expense equals the cost of the asset less its estimated salvage value. So at the end of its life, what do we believe we would be able to get for it, divided by the estimated useful life. So for example, on December 2016, equipment was purchased for $50,000 in cash. The equipment had a useful life of 5 years and an estimated salvage value of $5,000. Just take a second and populate this equation using this information. Estimated salvage value and estimated useful life are management decisions, so sometimes it's not 100% accurate. Things can happen in the course of an asset's life that may change that, but we start off with a very, very solid estimation based off management experience and the asset itself. So you should have created this actual formula of 50,000, the cost, less 5,000, the estimated salvage value, which gives us $45,000 divided by 5 years, yielding an annual depreciation expense of $9,000. One of the other things that most companies will have attached to every asset that exists that is subject to depreciation is a depreciation schedule. So for a straight line method, here's the depreciation schedule. You'll notice that the depreciation expense, the accumulated depreciation credit, the amount for that period, remains at $9,000 every year. There's your debit, there's your credit. However, as we go forward, we have our accumulated depreciation balance. Here's where we will continue to add. In the first year, we had 9,000. We added another 9, now we have 8. We added another 9, now we have 27. We added another 9, now we have 36. We added another 9, now we have 45,000. Depreciation stops when our net book value equals our salvage value. This is even if we continue to use or have the asset on our books for a time beyond the original estimated life. As I said, there are things that happen that can cause our original estimations to maybe not be as accurate as we had believed them to be. Your depreciation expense every fiscal period is reported on the income statement. We then continue to accumulate in the accumulated depreciation contra account, the accumulated depreciation that is used to calculate the net book value of the asset, which is then reported on the balance sheet. You'll see that the book value of the asset drops over time, whereas straight line method, the expense is the same every period. Because that is the case, there is a linear decrease in the net book value of the asset over its life. Another non-accelerated method is the units of production method. This calculates the depreciation expense based on a per unit produced. The formula is similar to the straight line method. We take the cost minus estimated salvage value, and then instead of dividing it by years of life, we divide it by the estimated total units to be made. Once the per unit depreciation expense is calculated, it is then multiplied by the number of units that are produced during the year to calculate the annual depreciation expense. This might be one of the most accurate cost allocation methods there is because it ties back to production. Production yields revenue. However, this is not necessarily a method that can actually be used for all assets. That is an estimation, the estimated total units to be made, that is not necessarily an aspect that applies to something such as, let's say, building in general. But if we look at it for, say, a piece of equipment, it works well. On December 31st, 2016, there was equipment that was purchased for $50,000 in cash. This piece of equipment is expected to produce 100,000 units during its useful life and have an estimated salvage value of $5,000. If we were to produce 22,000 units in 2017, the first year that the asset was used, what is the amount of the depreciation expense? Remember, you take cost less salvage value, then divide it by the number of units expected to be produced to get a per unit price. You then apply that per unit price to what production was for the year to ascertain what the annual depreciation expense is. In this case, at 45 cents per unit, multiplied by 22,000 units, we come up with $9,900 of annual depreciation expense for the year 2017. We would maintain a depreciation schedule for units of production method. In the units of production depreciation schedule, the number of units produced each year is in the first column. The annual depreciation expense, the accumulated depreciation balance, and the net book value are the following columns. Total number of units equals the estimated 100,000 units, and depreciation expense and accumulated depreciation balance will total 45,000, the depreciable amount. And thus, the undepreciated balance is going to equal $5,000 or the salvage value. Once you reach the salvage value, no depreciation expense is recorded. In a year in which the equipment perhaps sits idle, you did not create that product that year, there would be no depreciation expense associated with that asset. It did not contribute to production. And as you are using a units of production method, you would result at zero depreciation. We're going to begin talking about some of the accelerated methods. These are methods in which depreciation is higher in earlier years and lower in later years. One of those accelerated depreciation methods is the declining balance method. The declining balance method calculates the depreciation expense at double the straight line depreciation rate. To calculate the double straight line rate, we divide 1 by the estimated number of years of useful life, and then multiply that number by 2. Since we're using 2 times the straight line rate, sometimes this method is called double declining balance. Now, there are other types of declining balance, such as 1.5. So instead of multiplying by 2, you multiply by 1.5. Your annual depreciation expense formula for this is double the straight line depreciation rate times the book value at the beginning of the year. So to illustrate this, we have equipment purchased on December 31st, 2016 for $50,000 with an estimated useful life of 5 years, estimated residual value of $5,000. They want us to calculate the depreciation expense for 2017 and 2018, the first 2 years that the asset is used in the company. Now, keep in mind, we don't have to break this down onto a monthly or do a pro-rational because we are looking at full years. In reality, this is not actually going to happen. Many times you're going to end up with partial years in the first and last year. Just as a refresher, then you have to pro-ration the depreciation accordingly. First, we calculate the rate to be used. We divide 1 by the estimated number of years of useful life. 1 divided by 5 equals 0.20 or 20% straight line rate. We then multiply that 20% by 2 for double the straight line rate, which is 40%. This method always uses net book value at the beginning of that year. Net book value is determined by subtracting your accumulated depreciation from the original asset cost. To calculate the 2017 depreciation expense, we multiply the asset cost of $50,000 because it has yet to experience any depreciation, so it's still at full cost, by 40%. The depreciation expense equals $20,000. Depreciation expense for 2018 is calculated by first calculating the book value of the asset at the beginning of 2018. So this is $50,000 minus $20,000, which equals $30,000. We multiply that by the 40%, which gives us $12,000 for the depreciation expense for 2018. Again, we would have a depreciation schedule. Note that the declining balance schedule also is used to report the depreciation expense and the accumulated depreciation and the undepreciated balance, or the net book value. Salvage value is not deducted from the undepreciated balance to calculate the depreciation expense. You must be careful when depreciating not to depreciate the asset below the salvage value. In year 2021, go back, sorry. In year 2021, the calculated depreciation expense equals $2,592, as you see here. But that amount would reduce the net book value to $3,888, which is below the salvage value of $5,000. So in the later years, the depreciation is limited to the net book value times 40%, but the asset cannot be depreciated below salvage value.